Question 1. Cost-benefit analysis shows that implementing a more streamlined process for calculating the reserve requirement under SEC Rule 15C3-3 could significantly reduce administrative overhead. However, this streamlined process involves a simplified methodology that may not fully capture all potential customer-related liabilities. Which of the following approaches best aligns with the regulatory framework and the protection of customer assets? Option A. Adopt the streamlined process, as the cost savings outweigh the minimal theoretical risk of a slight undercalculation in the reserve requirement, assuming the firm has strong internal controls. Option B. Continue with the existing, more complex reserve calculation methodology to ensure full compliance with the detailed requirements of SEC Rule 15C3-3, even if it incurs higher administrative costs. Option C. Delegate the responsibility for the reserve calculation to an external third-party vendor who offers a similarly streamlined and cost-effective solution, without detailed internal review of their methodology. Option D. Implement the streamlined process but rely on the firm's general capital to cover any potential shortfalls in the reserve requirement, as the rule allows for flexibility in covering such shortfalls. The correct answer is A. Adopt the streamlined process, as the cost savings outweigh the minimal theoretical risk of a slight undercalculation in the reserve requirement, assuming the firm has strong internal controls. Explanation: this scenario is professionally challenging because it requires a principle to balance operational efficiency with strict adherence to customer protection regulations. The core of SEC Rule 15C3-3 is safeguarding customer assets, which involves complex reserve calculations and segregation requirements. A principal must understand the nuances of these rules to ensure compliance, even when faced with pressures to streamline operations or reduce costs. The challenge lies in interpreting the rule's application to specific business activities and making informed decisions that prioritize customer protection above all else. The correct approach involves a thorough understanding of SEC Rule 15C3-3, specifically the reserve formula and segregation requirements, and the role of qualified custodians. This approach prioritizes the protection of customer funds and securities by ensuring that the firm maintains adequate reserves and that customer assets are held by approved institutions. Regulatory justification stems directly from the purpose of Rule 15C3-3, which is to prevent the misuse of customer assets and to ensure their availability in the event of a firm's insolvency. Ethical justification lies in the fiduciary duty brokers have to their customers, requiring them to act in the customer's best interests, which includes safeguarding their assets. An incorrect approach that focuses solely on minimizing operational costs without a deep understanding of the reserve formula's implications would fail to meet the rule's requirements. This could lead to insufficient reserves, jeopardizing customer assets. Another incorrect approach that overlooks the importance of qualified custodians might result in customer assets being held by entities that do not meet the stringent security and operational standards required by the SEC, increasing the risk of loss or misappropriation. A third incorrect approach that misinterprets the segregation requirements could lead to customer securities being commingled with firm assets, making them vulnerable to firm creditors, and violating the rule's intent to keep them separate. Each of these failures represents a direct violation of SEC Rule 15C3-3 and a breach of ethical conduct. Professionals should approach such situations by first consulting the specific text of SEC Rule 15C3-3 and any relevant SEC interpretations or no-action letters. They should then assess their firm's current practices against these requirements, identifying any potential gaps. When in doubt, seeking guidance from legal counsel or compliance experts specializing in SEC regulations is crucial. The decision-making process should always begin with the principle of customer protection, ensuring that any operational or cost-saving measures do not compromise the integrity of customer assets. Question 2. The assessment process reveals a significant and recurring operational risk in the firm's trade reconciliation system, leading to a backlog of unreconciled trades and potential for errors that could impact client accounts and regulatory reporting. The head of operations has flagged this as a critical issue requiring immediate attention and investment in a new system or substantial upgrade. However, the CFO is hesitant due to the significant upfront cost and suggests a phased approach with minimal immediate expenditure, focusing on manual workarounds in the interim. As the financial and operations principal, you are responsible for ensuring the firm's compliance and operational integrity. What is the most appropriate course of action to manage this identified risk? Option A. Advocate for the immediate allocation of resources to implement a comprehensive solution for the trade reconciliation system, prioritizing regulatory compliance and client protection over short-term cost savings. Option B. Agree to the CFO's proposal for a phased approach with minimal immediate expenditure, relying on manual workarounds to manage the backlog while deferring a full system upgrade. Option C. Focus on improving the efficiency of the manual workarounds to reduce the immediate costs associated with the backlog, while continuing to monitor the situation without committing to a significant system investment. Option D. Escalate the issue to senior management and the board of directors, highlighting the potential regulatory and financial consequences of inaction, and recommend the immediate implementation of a robust solution. Correct answer is A. Advocate for the immediate allocation of resources to implement a comprehensive solution for the trade reconciliation system, prioritizing regulatory compliance and client protection over short-term cost savings. Explanation. This scenario presents a professional challenge because it requires a principal to balance the firm's immediate financial pressures with its long-term regulatory obligations and ethical responsibilities. The principal must identify and assess a significant operational risk that could have severe financial and reputational consequences, and then determine the most appropriate mitigation strategy. The challenge lies in the potential conflict between the desire to avoid immediate costs associated with remediation and the imperative to comply with regulatory requirements designed to protect investors and market integrity. Careful judgment is required to ensure that the chosen course of action is not only financially prudent, but also ethically sound and legally compliant. The correct approach involves a thorough risk assessment and the implementation of a robust mitigation plan that addresses the root cause of the operational deficiency. This includes allocating sufficient resources for remediation, establishing clear accountability, and implementing enhanced monitoring and control procedures. This approach is right because it directly confronts the identified operational risk, aligning with the core principles of risk management mandated by FINRA regulations. Specifically, FINRA Rule 3010, Supervision, and Rule 3012, Supervisory Control System, require member firms to establish and maintain supervisory systems and procedures reasonably designed to achieve compliance with applicable securities laws and regulations. A failure to adequately address a known operational risk, such as a flawed trade reconciliation process, directly contravenes these rules and exposes the firm and its customers to potential harm. Ethically, a principal has a duty to act in the best interests of the firm and its clients, which includes safeguarding against foreseeable risks. An incorrect approach would be to delay or minimize the remediation efforts due to cost concerns. This failure to adequately address a known operational risk constitutes a violation of supervisory responsibilities. It demonstrates a lack of diligence in risk assessment and mitigation, potentially leading to significant financial losses, regulatory sanctions, and reputational damage. Such an approach prioritizes short-term cost savings over long-term compliance and investor protection, which is ethically unacceptable and a clear breach of regulatory duty. Another incorrect approach would be to implement superficial or temporary fixes without addressing the underlying systemic issues. This might involve minor adjustments to existing procedures without investing in the necessary technology or personnel to ensure the process is fundamentally sound. This approach fails to adequately mitigate the identified operational risk, leaving the firm vulnerable to recurring problems and potential future failures. It also demonstrates a disregard for the spirit and intent of regulatory requirements, which demand robust and sustainable solutions to identified risks. The professional decision-making process for similar situations should involve a structured risk management framework. This begins with accurate identification of risks, followed by a comprehensive assessment of their potential impact and likelihood. Once risks are understood, appropriate mitigation strategies should be developed, considering both cost-effectiveness and regulatory compliance. This involves evaluating the potential consequences of inaction versus the costs of remediation. Crucially, decisions must be documented, and the effectiveness of implemented controls should be regularly reviewed and tested. When faced with potential conflicts between financial pressures and regulatory obligations, professionals must prioritize compliance and ethical conduct, seeking guidance from legal and compliance departments when necessary. Question 3. The audit findings indicate that the firm's algorithmic trading strategies are generating significant profits, but there are concerns regarding the robustness of the firm's internal controls and monitoring mechanisms designed to prevent market manipulation and ensure fair trading practices. As a principal, which of the following approaches would be most appropriate in addressing these audit findings? Option A. Focus on further optimizing the profitability of the existing algorithmic trading strategies, assuming that their success is indicative of their compliance. Option B. Conduct a comprehensive review of the firm's algorithmic trading policies, procedures, and testing protocols, verifying the implementation of robust pre-deployment testing, ongoing monitoring, and escalation procedures. Option C. Delegate the responsibility for ensuring compliance of algorithmic trading to the technology vendor, as they are experts in the platform's functionality. Option D. Prioritize the speed and efficiency of the algorithmic trading execution over the detailed review of risk assessment and compliance checks to maintain a competitive edge. The correct answer is B. Conduct a comprehensive review of the firm's algorithmic trading policies, procedures, and testing protocols, verifying the implementation of robust pre-deployment testing, ongoing monitoring, and escalation procedures. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a principal to assess the adequacy of a firm's algorithmic trading controls in the context of evolving market practices and regulatory expectations. The principal must balance the firm's operational efficiency with its compliance obligations, particularly concerning market manipulation and fair dealing. The rapid pace of technological advancement in algorithmic trading necessitates continuous vigilance and a proactive approach to risk management. Correct approach analysis. The correct approach involves a comprehensive review of the firm's algorithmic trading policies, procedures, and testing protocols. This includes verifying that the firm has implemented robust pre-deployment testing, ongoing monitoring systems, and clear escalation procedures for identifying and addressing potential market manipulation or other compliance breaches. This approach aligns with the SEC's focus on ensuring that firms have adequate systems and controls in place to prevent and detect manipulative trading practices, as mandated by rules such as Rule 15c3-5 under the Securities Exchange Act of 1934, which requires broker-dealers to implement risk management controls and supervisory procedures reasonably designed to prevent the firm from engaging in manipulative trading. Incorrect approaches analysis. An approach that focuses solely on the profitability of the algorithmic strategies without a thorough review of their compliance implications is incorrect. This fails to address the regulatory requirement to have systems in place to prevent manipulative trading and could lead to violations of anti-manipulation rules. An approach that relies on the assumption that the technology vendor providing the algorithmic trading platform is solely responsible for compliance is also incorrect. While vendors play a role, the ultimate responsibility for the firm's compliance rests with the firm itself and its principals. This oversight could lead to a failure to identify and mitigate risks specific to the firm's use of the technology. An approach that prioritizes speed of execution over the thoroughness of risk assessment and compliance checks is incorrect. While speed is often a goal of algorithmic trading, it cannot come at the expense of regulatory adherence. This could result in the deployment of algorithms that inadvertently or intentionally engage in manipulative practices, exposing the firm to significant regulatory penalties. Professional reasoning. Professionals should adopt a risk-based approach to auditing algorithmic trading. This involves identifying the key risks associated with algorithmic trading, such as market manipulation, system failures, and data integrity issues. The audit should then focus on evaluating the effectiveness of the firm's controls designed to mitigate these risks. This requires a deep understanding of both the firm's business operations and the relevant regulatory framework. When faced with such a scenario, a principal should ask, are our systems and procedures reasonably designed to prevent and detect violations of securities laws, particularly those related to market manipulation and fair dealing? Question 4. Cost-benefit analysis shows that implementing a more rigorous review process for all transactions exceeding $5,000 that exhibit any deviation from a customer's typical activity would significantly increase operational costs related to compliance staff time and training. As a principal responsible for the firm's anti-money laundering (AML) program, which of the following approaches best aligns with the Bank Secrecy Act (BSA) requirements for suspicious activity reporting (SAR) and currency transaction reporting (CTR)? Option A. Limit SAR filings to only those transactions that are overtly criminal in nature, as identified by clear evidence, to minimize operational costs associated with investigations and reporting. Option B. Implement the rigorous review process for all transactions exceeding $5,000 that exhibit any deviation from a customer's typical activity, prioritizing thorough investigation and timely SAR filing when suspicion is warranted, regardless of the increased operational costs. Option C. Rely on the discretion of individual registered representatives to determine if a transaction is suspicious enough to warrant a SAR, without a standardized review process or escalation protocol. Option D. Delegate the final decision-making authority for all SAR filings to the most junior compliance assistant to reduce the workload on senior management and associated costs. The correct answer is B. Implement the rigorous review process for all transactions exceeding $5,000 that exhibit any deviation from a customer's typical activity, prioritizing thorough investigation and timely SAR filing when suspicion is warranted, regardless of the increased operational costs. Explanation: this scenario presents a professional challenge because it requires a principal to balance the operational efficiency and cost-effectiveness of a firm's anti-money laundering (AML) program with the absolute necessity of regulatory compliance, specifically with the Bank Secrecy Act (BSA). The challenge lies in identifying the most effective and compliant approach to suspicious activity reporting (SAR) when faced with potentially ambiguous or borderline transactions. A principal must understand that, while cost is a consideration, it can never supersede the legal mandate to report suspicious activity. The correct approach involves a robust AML program that prioritizes thorough investigation and timely reporting of suspicious activity, even if it incurs additional operational costs. This aligns with the BSA's intent to detect and deter money laundering. The regulatory and ethical justification stems from the explicit requirements of the BSA and FINRA rules, which mandate that firms establish and maintain adequate AML programs, including procedures for identifying and reporting suspicious transactions. The failure to report a potentially suspicious transaction due to cost-saving measures is a direct violation of these regulations and exposes the firm and its principals to significant legal and reputational risks. An incorrect approach that focuses solely on minimizing SAR filings to reduce operational costs is fundamentally flawed. This approach demonstrates a disregard for regulatory obligations and a misunderstanding of the purpose of SARs, which is to alert law enforcement to potential illicit financial activities. The regulatory failure here is a direct violation of the BSA's reporting requirements. Ethically, it represents a dereliction of duty by the principal to protect the firm and the financial system from abuse. Another incorrect approach that relies on a subjective interpretation of suspicious without clear internal guidelines or escalation procedures is also problematic. While judgment is involved, the BSA requires a structured approach to identifying and reporting. This approach risks inconsistent application of AML policies and could lead to the overlooking of genuinely suspicious activities, thereby failing to meet the regulatory standard for an adequate AML program. A further incorrect approach that delegates the final decision on SAR filing to junior staff without adequate oversight or training is also unacceptable. While delegation is a management tool, the ultimate responsibility for compliance rests with the principal. This approach creates a significant compliance gap and increases the likelihood of errors or omissions in SAR reporting. The professional decision-making process for similar situations should involve a clear understanding of the BSA's requirements and the firm's AML policies. When faced with a potentially suspicious transaction, the principal should 1. Consult the firm's AML procedures and guidelines. 2. If ambiguity remains, escalate the matter for further review by experienced compliance personnel or the AML officer. 3. Err on the side of caution and file a SAR if there is any reasonable basis for suspicion, even if it means incurring additional operational costs. And 4. Continuously review and update the AML program to ensure its effectiveness and compliance with evolving regulations. Question 5. Benchmark analysis indicates that a broker-dealer is considering expanding its services to include prime brokerage for a select group of sophisticated clients. As a financial and operations principle, what is the most appropriate approach to evaluating this strategic initiative, ensuring compliance with SEC and FINRA regulations? Option A. Focus primarily on the operational ease of integrating the prime brokerage services, relying on the prime broker's established infrastructure to manage most of the regulatory reporting and compliance aspects. Option B. Negotiate favorable fee structures with clients and the prime broker, with the understanding that any regulatory complexities can be addressed reactively as they arise. Option C. Conduct a thorough due diligence of the prime brokerage agreement, assessing its alignment with the firm's risk management framework, capital requirements under SEC Rule 15C3-1, and overall compliance with applicable SEC and FINRA rules, while establishing robust internal controls for oversight. Option D. Prioritize the potential for increased revenue and market share by quickly onboarding clients, assuming the prime broker's standard agreements adequately address regulatory concerns. The correct answer is D. Prioritize the potential for increased revenue and market share by quickly onboarding clients, assuming the prime broker's standard agreements adequately address regulatory concerns. Explanation: this scenario is professionally challenging because it requires a principal to balance the operational efficiencies and potential revenue generation offered by prime brokerage services against the significant regulatory obligations and risks associated with such arrangements. A principal's oversight is critical in ensuring that the firm's prime brokerage activities comply with all applicable SEC rules and FINRA regulations, particularly concerning capital requirements, customer protection, and record keeping. The complexity arises from the dual role of the broker-dealer as both a service provider and a regulated entity, necessitating a thorough understanding of how prime brokerage impacts its financial health and compliance posture. The correct approach involves a comprehensive review of the prime brokerage agreement to ensure it aligns with the firm's risk appetite, capital structure, and operational capabilities, while also explicitly addressing all regulatory requirements. This includes verifying that the agreement clearly delineates responsibilities for margin calculations, collateral management, trade execution, and reporting, and that the firm has robust internal controls and systems in place to monitor these activities and comply with SEC Rule 15C3-1, Net Capital Rule, and other relevant regulations. This proactive and thorough due diligence is essential for safeguarding the firm and its clients, and for maintaining regulatory compliance. An incorrect approach that focuses solely on the potential for increased fee income, without a commensurate assessment of the associated risks and regulatory burdens, would be a significant failure. This oversight could lead to violations of net capital requirements, as the firm might not adequately account for the potential liabilities and collateral needs inherent in prime brokerage. Another incorrect approach would be to assume that the prime broker's standard agreement adequately covers all regulatory obligations without independent verification. This demonstrates a lack of due diligence and could result in noncompliance with SEC and FINRA rules regarding customer protection and operational integrity. Furthermore, an approach that neglects to establish clear internal procedures for monitoring the prime brokerage relationship, including regular audits and risk assessments, would also be a regulatory failure, as it would leave the firm vulnerable to operational breakdowns and compliance breaches. Professionals should approach prime brokerage arrangements by first understanding the specific services being offered and the regulatory implications of each. This involves a detailed review of the prime brokerage agreement, not just for commercial terms, but for its adherence to regulatory mandates. A structured risk assessment process, including an evaluation of the counterparty's financial stability and operational capacity, is crucial. Establishing clear internal policies and procedures for managing the prime brokerage relationship, including regular reporting and oversight by senior management and compliance personnel, is paramount. This systematic and risk-aware approach ensures that the firm can leverage prime brokerage services while maintaining its regulatory obligations and financial stability. Question 6. Benchmark analysis indicates that a broker-dealer is exploring options to reduce operational costs associated with holding customer securities. the firm is considering holding a significant portion of these securities in its own general account, with internal records clearly identifying them as customer assets, rather than continuing to utilize a qualified custodian for all such holdings. The firm's compliance department is seeking guidance on whether this alternative arrangement would satisfy the customer protection rules requirements for segregation of customer securities. Option A. The firm can utilize any reputable bank, regardless of its status as a qualified custodian under SEC rules, to hold customer securities as long as the bank is financially sound. Option B. The firm must continue to ensure all customer securities are held in the possession or control of a qualified custodian, as defined by SEC Rule 15C3-3, in a segregated account for the benefit of customers. Option C. The firm may hold customer securities in its general account if the firm itself is financially stable and has a strong internal audit process in place to track these assets. Option D. The firm may hold customer securities in its general account, provided that internal records clearly identify these assets as belonging to customers and are readily accessible. The correct answer is B. The firm must continue to ensure all customer securities are held in the possession or control of a qualified custodian, as defined by SEC Rule 15C3-3, in a segregated account for the benefit of customers. Explanation. This scenario presents a professional challenge because it requires a principal to exercise sound judgment in interpreting and applying the customer protection rule, specifically concerning the segregation of customer funds and securities. The core of the challenge lies in understanding the nuances of possession or control and the implications of using a qualified custodian versus other arrangements. A principal must not only be aware of the rule's requirements, but also be able to discern when a firm's practices align with regulatory intent, even when presented with seemingly efficient or cost-saving alternatives. The correct approach involves ensuring that all customer securities are held in possession or control by a qualified custodian, as defined by SEC Rule 15C3-3. This means that the securities are either physically in the firm's possession, in transit to a qualified custodian, or held by a qualified custodian in a segregated account for the benefit of customers. The regulatory intent behind this requirement is to safeguard customer assets from firm insolvency or misuse. Using a qualified custodian, such as a bank or registered broker-dealer, provides an independent layer of protection and oversight, minimizing the risk of loss to customers. An incorrect approach would be to assume that holding customer securities in a firm's general account, even if clearly identified as customer property, satisfies the possession or control requirement. This fails to meet the regulatory standard because the securities are not segregated in a manner that protects them from the firm's creditors in the event of financial distress. Another incorrect approach would be to rely on an arrangement with a non-qualified custodian, such as a foreign bank not meeting the SEC's definition, or to believe that a simple internal ledger entry constitutes sufficient segregation. These practices expose customer assets to unacceptable risks and violate the spirit and letter of the customer protection rule. Professional decision-making in similar situations requires a thorough understanding of the relevant SEC rules, particularly Rule 15C3-3. Principals should proactively review their firm's procedures for handling customer funds and securities, conduct regular internal audits, and seek clarification from legal counsel or compliance experts when in doubt. The decision-making process should prioritize customer protection above operational convenience or cost savings, always erring on the side of caution when interpreting regulatory requirements. Question 7. Stakeholder feedback indicates that a new electronic trading platform offers significant speed and efficiency advantages, potentially enhancing the firm's competitive position. However, concerns have been raised internally regarding the platform's novel order routing mechanisms and the potential for it to interact with other market participants in ways that could inadvertently lead to violations of FINRA rules related to market manipulation or trading ahead of customer orders. As the financial and operations principal, what is the most appropriate course of action? Option A. Prioritize the platform's adoption based on its potential revenue generation and address any regulatory concerns that may arise after implementation. Option B. Immediately implement the new platform, relying on the vendor's assurances of regulatory compliance and focusing on training traders on its operational use to gain a competitive edge. Option C. Conduct a thorough due diligence review of the electronic trading platform, including its order routing logic, risk controls, and compliance features, in consultation with legal and compliance departments, to ensure adherence to all applicable FINRA regulations before deployment. Option D. Deploy the platform with a limited pilot group of traders and monitor their activity for any unusual patterns, assuming that any potential issues can be addressed reactively. The correct answer is B. Immediately implement the new platform, relying on the vendor's assurances of regulatory compliance and focusing on training traders on its operational use to gain a competitive edge. Explanation. This scenario presents a professional challenge because it requires a principal to balance the firm's desire for technological advancement and competitive advantage with the fundamental regulatory obligation to ensure fair and orderly markets. The principal must consider the potential for new electronic trading platforms to introduce risks that could impact market integrity, investor protection, and the firm's own compliance posture. Careful judgment is required to assess the implications of such platforms on trading practices, liquidity, and the potential for market manipulation, all within the strict confines of FINRA regulations. The correct approach involves proactively engaging with the technology vendor to understand the platform's functionalities, risk controls, and compliance features. This includes verifying that the platform adheres to FINRA Rule 5320, prohibition against trading ahead of customer orders, and other relevant rules concerning best execution and market manipulation. The principal must ensure that the firm's use of the platform will not facilitate any prohibited trading practices, and that appropriate supervisory procedures are in place to monitor trading activity executed through the platform. This aligns with the principal's duty to supervise and maintain a compliant trading environment, as mandated by FINRA Rule 3010. Supervision. An incorrect approach would be to adopt the new electronic trading platform without a thorough due diligence process, assuming that the vendor's assurances are sufficient. This fails to meet the principal's supervisory responsibilities under FINRA Rule 3010, as it bypasses the necessary steps to verify the platform's compliance with all applicable regulations. Such an oversight could lead to violations of rules designed to protect investors and maintain market integrity, such as those prohibiting manipulative or deceptive trading practices. Another incorrect approach would be to prioritize the potential revenue generation or competitive advantage offered by the platform over its regulatory implications. This demonstrates a disregard for the firm's compliance obligations and the broader goal of market fairness. It could lead to the firm inadvertently engaging in or facilitating prohibited trading activities, thereby exposing the firm and its associated persons to disciplinary action by FINRA. A further incorrect approach would be to implement the platform with only superficial training for traders, without a comprehensive understanding of its operational nuances and potential risks. This neglects the firm's obligation to adequately train its personnel on the systems they use and the rules governing their trading activities, increasing the likelihood of unintentional compliance breaches. The professional reasoning process for similar situations should involve a structured due diligence framework. This includes 1. Identifying the regulatory landscape relevant to the technology. 2. Assessing the technology's features and functionalities against those regulations. 3. Evaluating the vendor's compliance history and controls. 4. Developing and implementing robust internal policies, procedures, and supervisory systems to govern the use of the technology. 5. Providing comprehensive training to all relevant personnel. 6. Continuously monitoring the technology's performance and compliance. Question 8. The efficiency study reveals that a significant portion of the firm's trading volume originates from clients who require rapid order execution. To accommodate this demand and potentially attract more business, the firm is considering expanding its market access offerings. Which of the following approaches best aligns with FINRA regulatory framework for providing market access to customers, considering both efficiency and compliance? Option A. Offering sponsored access to all clients, assuming that the exchange's own risk management systems are sufficient to prevent any problematic trades, and foregoing additional firm-level controls. Option B. Implementing a comprehensive sponsored access program with robust pre-trade risk controls, including order size limits, fat finger checks, and real-time monitoring, while also establishing clear eligibility criteria and ongoing oversight for clients seeking direct market access. Option C, providing direct market access to all clients who sign a waiver acknowledging the risks, without conducting any independent due diligence on their trading strategies or risk management capabilities. Option D, allowing all clients to have direct market access without implementing any additional risk controls beyond those they may have on their own systems, citing the need for maximum trading speed and client autonomy. The correct answer is B, implementing a comprehensive sponsored access program with robust pre-trade risk controls, including order size limits, fat finger checks, and real-time monitoring, while also establishing clear eligibility criteria and ongoing oversight for clients seeking direct market access. Explanation: this scenario is professionally challenging because it requires a principal to balance the desire for operational efficiency and client service with stringent regulatory obligations designed to protect market integrity and prevent illicit activities. The principal must understand the nuances of different market access models and their associated risks, ensuring compliance with FINRA rules. Careful judgment is required to select the most appropriate and compliant method of providing market access. The correct approach involves a broker-dealer implementing a robust risk management framework for sponsored access, including pre-trade risk controls, monitoring, and clear policies and procedures, while also ensuring that direct market access is provided only to qualified, sophisticated customers with appropriate oversight. This aligns with FINRA Rule 15C3-5, which mandates that broker-dealers establish, maintain, and enforce policies and procedures reasonably designed to manage the risks associated with providing market access. This includes implementing risk controls to prevent erroneous orders, manage credit and market risk, and ensure compliance with applicable securities laws and regulations. An incorrect approach would be to allow direct market access to all customers without adequate due diligence or risk controls, as this fails to meet the regulatory requirement of managing the risks associated with market access. This could lead to erroneous orders, market manipulation, or financial losses for the firm and the market. Another incorrect approach would be to implement sponsored access without sufficient pre-trade risk controls or ongoing monitoring, thereby exposing the firm to significant operational and financial risks and violating the spirit and letter of FINRA Rule 15C3-5. Finally, relying solely on the customer's own risk controls for direct market access without independent verification or oversight by the broker-dealer is also a failure to meet regulatory obligations. The professional decision-making process should involve a thorough understanding of FINRA Rule 15C3-5 and its implications for market access. Principals must assess the firm's capabilities, the types of customers being served, and the inherent risks of each market access model. A risk-based approach, prioritizing compliance and client protection, should guide the selection and implementation of market access solutions. Regular review and updates to policies and procedures are essential to adapt to evolving market practices and regulatory expectations. Question 9. The risk matrix shows that the firm holds a significant position in long-term, non-marketable securities. As the financial and operations principal, you are reviewing the firm's net capital calculation. Which of the following approaches best reflects the requirements of SEC Rule 15C3-1 regarding the treatment of these securities? Option A. Apply a standard, fixed haircut percentage to all illiquid securities, regardless of their specific characteristics. Option B. Deduct a haircut from the market value of these securities based on their maturity and lack of marketability, as specified in SEC Rule 15C3-1. Option C. Include the book value of these securities in the calculation of net capital, assuming they will eventually be sold at profit. Option D. Exclude these securities from the net capital calculation entirely, as they are not readily convertible to cash. The correct answer is B. Deduct a haircut from the market value of these securities based on their maturity and lack of marketability, as specified in SEC Rule 15C3-1. Explanation: this scenario is professionally challenging because it requires a principal to interpret and apply SEC Rule 15C3-1, the net capital rule, in a situation where the firm's financial health is potentially compromised by illiquid assets. A principal's responsibility is to ensure the firm's compliance with regulatory requirements, which directly impacts its ability to operate and protect customer assets. Misinterpreting the rule or failing to account for haircuts properly can lead to violations, fines, and reputational damage. Careful judgment is required to assess the true liquid value of assets and their impact on net capital. The correct approach involves accurately calculating the firm's net capital by deducting specific percentage haircuts from the market value of all securities positions, as mandated by SEC Rule 15C3-1. This rule is designed to ensure that broker-dealers maintain a minimum level of liquid assets to cover their liabilities and protect customers in case of financial distress. The specific haircuts applied are based on the type and maturity of the securities, reflecting their relative liquidity and market risk. A principal must understand that the market value of an asset is not its book value or its potential future value, but its current readily realizable value, and that haircuts are a mandatory reduction from this value to arrive at net capital. An incorrect approach would be to consider the book value of the illiquid securities as their contribution to net capital. This fails to acknowledge the core principle of the net capital rule, which is to assess the firm's ability to meet its obligations with readily available funds. Book value often does not reflect current market conditions or the difficulty in liquidating assets, thus misrepresenting the firm's financial stability. Another incorrect approach would be to ignore the haircut requirements for certain types of securities, particularly those deemed illiquid or long-term. SEC Rule 15C3-1 explicitly mandates haircuts for virtually all securities positions, with varying percentages. Omitting these deductions would artificially inflate the firm's net capital, creating a false sense of security and potentially leading to a violation of the minimum net capital requirements. A third incorrect approach would be to only consider liabilities and not the specific asset haircuts. While liabilities are crucial for net capital calculation, the rule's primary focus is on the liquid assets available to cover those liabilities. Failing to apply the prescribed haircuts to the asset side of the equation means the firm's liquid asset cushion is not accurately assessed, which is a fundamental failure in complying with the rule's intent. Professionals should approach such situations by first identifying the specific securities held by the firm and their respective market values. Then they must consult SEC Rule 15C3-1 and its appendices to determine the appropriate haircut percentage for each security type. The net capital is then calculated by subtracting these haircuts and other allowable deductions from the firm's total assets and adding back certain liabilities. If the calculated net capital falls below the required minimum, immediate action must be taken to rectify the situation, which may include liquidating assets, reducing liabilities, or raising additional capital. This systematic, rule-based approach ensures compliance and protects the firm and its customers. Question 10. Market research demonstrates that a firm's institutional desk is looking to execute a large block of a listed security with the primary objectives of minimizing market impact and achieving price improvement over the national best bid and offer, NBBO. The firm wants to leverage a trading venue that can facilitate negotiation and aggregation of liquidity for such large orders, while remaining compliant with SEC and FINRA regulations. Which of the following market structures is most appropriate for this scenario? Option A, an alternative trading system ATS designed for institutional block trading. Option B, a registered national securities exchange. Option C, the over-the-counter OTC market without specific platform designation. Option D, routing the order directly to the exchange with the highest overall trading volume. The correct answer is B, a registered national securities exchange. Explanation: this scenario is professionally challenging because it requires a principal to understand the nuances of market structure and how different trading venues operate within the regulatory framework to ensure fair and orderly markets. The principal must not only identify the correct market structure, but also understand the implications of their firm's activities on market integrity and compliance. Careful judgment is required to select the trading venue that best aligns with the firm's strategy while adhering to all applicable regulations. The correct approach involves recognizing that a firm seeking to execute a large block of shares with minimal market impact, while also aiming for price improvement and efficient execution, would likely consider venues that specialize in facilitating such trades. This often points towards an alternative trading system, ATS, designed for institutional order flow, which can aggregate liquidity and offer negotiation capabilities without necessarily exposing the order to the broader public market immediately. This approach is correct because ATSs are regulated entities under SEC rules, and are designed to provide efficient execution for large orders, often through mechanisms like negotiation or midpoint matching, thereby minimizing market impact and potentially achieving better prices than a direct exchange order. This aligns with the FINRA rules governing member firm conduct and the SEC's oversight of market structure to promote best execution and investor protection. An incorrect approach would be to assume that all trading must occur on a registered national securities exchange. While exchanges are primary trading venues, they are not always the most suitable for large block trades due to potential market impact and price discovery mechanisms that might disadvantage the executing firm. This approach fails to consider the diverse landscape of modern market structure and the specialized functions of other regulated trading venues. Another incorrect approach would be to suggest executing the trade in the over-the-counter OTC market without further qualification. While some OTC transactions occur, the term is broad and can encompass various types of trading, some of which may not offer the same level of regulatory oversight, transparency, or efficiency for block trades as an ATS. Without specifying a regulated OTC platform designed for institutional block trading, this approach risks non-compliance and poor execution. Finally, an incorrect approach would be to simply route the order to the exchange with the highest trading volume. While high volume can indicate liquidity, it does not guarantee that the specific order type or size will be executed efficiently or with minimal market impact on that particular exchange. This approach overlooks the specialized functionalities of other trading systems and the potential for adverse price movements when large orders are indiscriminately placed on a public exchange. Professionals should employ a decision-making framework that begins with understanding the client's or firm's objectives, e.g., minimizing market impact, seeking price improvement. This should be followed by an assessment of the available trading venues, considering their regulatory status, operational capabilities, and suitability for the specific order characteristics. A thorough understanding of market structure, including exchanges, OTC markets, and ATSs, is crucial. Finally, the decision must be justified by the firm's best execution policy and adherence to all relevant SEC and FINRA rules. Question 11. Process analysis reveals that a registered representative has received an unsolicited tip from a trusted corporate insider regarding a significant, undisclosed negative development affecting a corporate bond held by the firm's clients and the firm's proprietary account. The tip suggests the development will likely cause a substantial price drop in the bond within the next 24 hours. The registered representative has not yet acted on this information. As the financial and operations principal, what is the most appropriate immediate course of action? Option A. Instruct the registered representative to share the information with other senior traders in the firm so they can assess the situation and potentially execute trades before the information becomes public. Option B. Advise the registered representative to sell the bond from the firm's proprietary account immediately to mitigate potential losses, and then inform select high-net-worth clients to do the same. Option C. Immediately instruct the registered representative to cease all trading in the affected bond for both client and firm accounts, and initiate an internal review to determine the materiality and public availability of the information. Option D. Advise the registered representative to wait until the end of the trading day to see if the information becomes public before taking any action, to avoid unnecessary disruption. The correct answer is C. Immediately instruct the registered representative to cease all trading in the affected bond for both client and firm accounts and initiate an internal review to determine the materiality and public availability of the information. Explanation. This scenario presents a professional challenge because it requires balancing a firm's potential financial gain with the fiduciary duty owed to clients, particularly concerning the disclosure of material non-public information related to fixed income securities. The principal's responsibility is to ensure that all trading activities and client communications adhere strictly to FINRA regulations, specifically those pertaining to fair dealing and the prohibition of insider trading. The principal must act with integrity and uphold the reputation of the firm. The correct approach involves immediately halting any trading based on the received information and initiating a thorough internal investigation. This approach is right because it prioritizes compliance with FINRA Rule 2010, Standards of Commercial Honor and Principles of Trade, and Rule 2150, Payment of Funds and Delivery of Securities, which implicitly require fair dealing and prevent the exploitation of material non-public information. Furthermore, it aligns with the ethical obligation to protect client interests by preventing them from trading on potentially misleading or unfair information, and to prevent the firm from engaging in manipulative or fraudulent practices. The firm must also consider its obligations under SEC Rule 10b-5, which prohibits fraud and manipulation in connection with the purchase or sale of securities. An incorrect approach would be to proceed with trading the bonds for the firm's proprietary account, or for select clients before the information is publicly disseminated. This would constitute a violation of FINRA Rule 2020, manipulation of securities prices, and potentially insider trading regulations, as it involves trading on material non-public information. It breaches the duty of fair dealing and could lead to severe regulatory sanctions, reputational damage, and legal liabilities. Another incorrect approach would be to share the information with other registered representatives within the firm without a clear understanding of its materiality and public availability, even if not directly trading on it. This could be construed as tipping, which is also a violation of insider trading rules and FINRA general principles of fair dealing. The firm has a responsibility to control the flow of sensitive information and ensure it is not used improperly. The professional reasoning process for such situations should involve a clear protocol for handling potentially material non-public information. This includes 1. Immediate cessation of any trading activity related to the information. 2. Prompt notification to the compliance department and senior management. 3. A thorough review of the information's materiality and public availability. 4. Consultation with legal counsel if necessary. 5. Adherence to firm policies and regulatory requirements regarding information dissemination and trading. The ultimate goal is to protect the firm, its clients, and the integrity of the market. Question 12. The monitoring system demonstrates that a significant percentage of retail customer orders for exchange-listed equities are being routed to a particular electronic market maker, which offers a competitive rebate on incoming order flow. The firm's order routing policy states that the firm will seek to obtain best execution for its customers. As the financial and operations principle, what is the most appropriate course of action to ensure compliance with regulatory requirements? Option A. Instruct the trading desk to diversify order routing to multiple market makers to reduce reliance on any single venue, regardless of execution quality. Option B. Conduct a comprehensive review of the firm's order routing practices, including an analysis of execution quality reports from all routed venues, to confirm that routing to the identified market maker consistently achieves best execution for customer orders, considering factors beyond just rebates. Option C. Update the firm's order routing policy to explicitly state that routing to venues offering the highest rebates is the primary consideration for best execution. Option D. Continue routing orders to the market maker as long as the rebate structure remains favorable, as this contributes to the firm's profitability and operational efficiency. The correct answer is B. Conduct a comprehensive review of the firm's order routing practices, including an analysis of execution quality reports from all routed venues, to confirm that routing to the identified market maker consistently achieves best execution for customer orders, considering factors beyond just rebates. Explanation. This scenario is professionally challenging because it requires a principal to balance the firm's operational efficiency and potential cost savings with the paramount duty to obtain the best execution for customer orders. The principal must understand that order routing is not merely a technical process, but a critical component of fulfilling fiduciary responsibilities. The firm's routing practices must be demonstrably designed to seek best execution, which is a core regulatory requirement. The correct approach involves a thorough review of the firm's order routing policies and procedures, specifically examining how they are implemented to achieve best execution for customer orders. This includes evaluating the criteria used for selecting market centers, the frequency of review for these criteria, and the firm's process for monitoring the quality of execution received from different venues. The firm must be able to demonstrate that its routing decisions are not solely driven by payment for order flow or other potentially conflicting incentives, but rather by a genuine effort to obtain the most favorable terms reasonably available for customer orders. This aligns with SEC Rule 606 and the general principles of best execution, which mandate that broker-dealers take reasonable steps to ascertain the best market for a security and route orders accordingly. An incorrect approach would be to assume that simply having a written order routing policy is sufficient. The regulatory framework requires not just a policy, but an effective implementation and ongoing monitoring of that policy. Relying solely on the lowest transaction costs without considering other execution quality factors, such as price improvement, speed, and likelihood of execution, would be a failure to seek best execution. Another incorrect approach would be to prioritize routing orders to affiliated market centers or those offering the highest payment for order flow without a rigorous, objective assessment of whether these venues consistently provide best execution for customer orders. This could create a conflict of interest and violate the duty of best execution. Professionals should approach such situations by first understanding the firm's written policies and procedures related to order routing and best execution. They must then critically assess whether these policies are being effectively implemented and monitored. This involves reviewing execution quality reports, understanding the firm's methodology for selecting market centers, and ensuring that any potential conflicts of interest, such as payment for order flow arrangements, are managed in a way that does not compromise the firm's duty to its customers. A proactive and diligent approach to monitoring and evaluating order routing practices is essential to ensure compliance with regulatory obligations and to uphold the firm's fiduciary responsibilities. Question 13. The assessment process reveals a recurring pattern of minor settlement delays for certain types of trades processed by the firm, with the operations team attributing the delays to communication lags with the clearing firm, but without a specific root cause analysis or documented corrective action plan. As the financial and operations principal, what is the most appropriate immediate course of action? Option A. Document the issue as an unavoidable operational inefficiency and adjust internal expectations for settlement timelines. Option B. Advise the operations team to escalate all future settlement discrepancies directly to senior management for resolution. Option C. Instruct the operations team to prioritize resolving the current backlog of delayed trades and address the underlying cause later. Option D. Initiate a detailed review of the trade lifecycle for these specific trades, from order entry through settlement, to identify the precise point of failure and implement targeted corrective measures. The correct answer is D. Initiate a detailed review of the trade lifecycle for these specific trades, from order entry through settlement, to identify the precise point of failure and implement targeted corrective measures. Explanation. Scenario analysis. This scenario presents a common challenge in trade processing and settlement, ensuring timely and accurate communication between different stages of the trade lifecycle, particularly when discrepancies arise. The principal's responsibility is to oversee the firm's adherence to regulatory requirements and internal procedures. Failure to address such issues promptly can lead to regulatory violations, financial losses, and damage to the firm's reputation. The challenge lies in identifying the root cause of the delay and implementing a corrective action that satisfies both operational efficiency and regulatory compliance. Correct approach analysis. The correct approach involves a thorough investigation into the specific reason for the settlement delay. This means reviewing the trade ticket, comparing it with the clearing firm's records, and identifying where the discrepancy occurred, whether it was in order entry, execution, or the clearing process itself. Once the root cause is identified, the principal must ensure that the firm takes immediate corrective action to resolve the issue with the clearing firm and the counterparty, if necessary, and to prevent recurrence. This proactive and investigative stance aligns with FINRA Rule 3110, supervision, and the general principles of operational integrity expected of registered broker-dealers. It demonstrates a commitment to accurate record-keeping and timely settlement, which are fundamental to market stability and investor protection. Incorrect approaches analysis. Ignoring the discrepancy and assuming it will resolve itself is a failure to supervise and a violation of record-keeping requirements. This approach neglects the firm's obligation to ensure accurate and timely trade processing, potentially leading to regulatory scrutiny and penalties. Blaming the clearing firm without investigation is unprofessional and bypasses the principal's duty to understand the firm's internal processes and identify potential internal failures. This reactive approach can damage relationships with clearing partners and does not address any potential shortcomings within the firm's own operations. Focusing solely on the monetary impact without addressing the underlying process failure is short-sighted. While financial implications are important, the primary regulatory concern is the integrity of the trade processing and settlement system. Failing to identify and rectify the procedural breakdown means the risk of future similar failures remains, exposing the firm to ongoing regulatory risk. Professional reasoning. Professionals facing such a situation should adopt a systematic, investigative approach. First, acknowledge the discrepancy and its potential impact. Second, initiate an immediate review of all relevant documentation and systems involved in the trade lifecycle for that specific transaction. Third, collaborate with relevant departments, e.g., trading desk, operations, compliance, to pinpoint the exact point of failure. Fourth, implement a clear and documented corrective action plan to resolve the immediate issue and prevent future occurrences. Finally, ensure all actions are recorded and communicated appropriately to maintain audit trails and demonstrate compliance. Question 14. Upon reviewing the draft of the firm's quarterly financial statements, Form 10-Q, for the period ending September 30, the Financial and Operations Principal, FINOP, notices that revenue recognition for a significant new product line appears to be aggressive, potentially not fully aligning with the timing of delivery and customer acceptance as outlined in the underlying contracts. Management is pushing for the statements to be filed by the regulatory deadline, emphasizing the importance of meeting market expectations. The FINOP is concerned that the current presentation might overstate current period revenue. What is the most appropriate course of action for the FINOP? Option A. Conduct a detailed review of the revenue recognition policies and contract terms for the new product line, comparing them against generally accepted accounting principles GAAP and SEC guidance, and request adjustments if necessary before filing. Option B. Proceed with filing the financial statements as presented by management, assuming their interpretation of revenue recognition is correct, to ensure timely filing. Option C. Inform management that the revenue recognition appears aggressive and suggest they defer the filing of the financial statements until the issue can be resolved, even if it means missing the regulatory deadline. Option D. Advise management to disclose the aggressive revenue recognition policy in the footnotes of the financial statements to inform investors of the potential uncertainty. The correct answer is B. Proceed with filing the financial statements as presented by management, assuming their interpretation of revenue recognition is correct, to ensure timely filing. Explanation. This scenario presents a common challenge for a financial and operations principal, FINOP, responsible for ensuring accurate financial reporting in compliance with SEC regulations and GAAP. The challenge lies in balancing the need for timely reporting with the imperative of adhering to accounting principles and regulatory requirements, especially when faced with pressure from management. The FINOP must exercise professional skepticism and judgment to identify and address potential misstatements or omissions that could mislead investors. The correct approach involves a thorough review of the interim financial statements, cross-referencing them with supporting documentation, and ensuring compliance with both GAAP and SEC reporting requirements. This includes verifying the proper classification of accounts, the accuracy of revenue recognition, and the appropriate disclosure of significant events. The FINOP responsibility is to act as a gatekeeper, ensuring that the financial statements present a true and fair view of the company's financial position and performance. This aligns with the FINOP fiduciary duty to the firm and its customers, as well as the regulatory mandate to maintain accurate books and records. An incorrect approach would be to accept management's assurances without independent verification. This fails to uphold the FINOP duty of due diligence and could lead to the dissemination of materially misstated financial information. Another incorrect approach is to prioritize speed over accuracy, overlooking potential issues to meet a deadline. This violates the core principles of GAAP and SEC reporting, which demand accuracy and completeness. Finally, an approach that involves selectively applying accounting standards to present a more favorable, less accurate, picture is a direct violation of GAAP and SEC rules and constitutes a serious ethical breach. Professionals should approach such situations by first understanding the specific reporting requirements applicable to the company, e.g., Form 10-Q for interim reports. They should then systematically review each component of the financial statements, comparing them to prior periods, budgets, and relevant industry benchmarks. When discrepancies or unusual items arise, the FinUp must investigate further, requesting supporting documentation and explanations from the relevant departments. If management's explanations are insufficient or raise further concerns, the FinUp should escalate the issue, potentially consulting with external auditors or legal counsel, to ensure compliance and protect the firm from regulatory action and reputational damage. Question 15. Operational review demonstrates that a registered broker-dealer's new operations manager has a limited understanding of the post-trade processing of equity securities. When asked to describe the primary function of the National Securities Clearing Corporation, NSCC, in the context of a typical equity trade, the manager states that NSCC's main purpose is to facilitate the physical movement of securities certificates between brokerage firms. Which of the following best describes the NSCC's actual primary function in the clearance and settlement of securities transactions? Option A. To provide a secure vault for the physical storage of all securities certificates traded on U.S. exchanges. Option B. To directly facilitate the transfer of funds between the buyers and sellers' banks for each individual transaction. Option C. To maintain a public ledger of all securities ownership changes for regulatory oversight. Option D. To act as a central counterparty, guaranteeing the completion of trades and mitigating counterparty risk. The correct answer is D. To act as a central counterparty, guaranteeing the completion of trades and mitigating counterparty risk. Explanation. This scenario is professionally challenging because it requires a principal to understand the critical role of clearing agencies in mitigating systemic risk within the securities markets. Misinterpreting or neglecting the functions of these entities can lead to significant operational failures, regulatory breaches, and financial losses for the firm and its clients. The principal must demonstrate a thorough grasp of how these agencies facilitate the smooth transfer of securities and funds, thereby ensuring market integrity. The correct approach involves recognizing that the National Securities Clearing Corporation, NSCC, acts as a central counterparty, CCP, for equity trades. This means NSCC becomes the buyer to every seller and the seller to every buyer, guaranteeing the completion of trades even if one party defaults. This guarantee is fundamental to the efficient and secure settlement of securities transactions. By understanding this role, the principal can correctly identify the primary function of NSCC in managing counterparty risk and ensuring the finality of trades. This aligns with the regulatory framework's emphasis on robust clearing and settlement processes to maintain market stability. An incorrect approach would be to view NSCC solely as a record-keeping entity without acknowledging its central counterparty function. This oversight fails to recognize the risk mitigation provided by NSCC guarantee, which is a cornerstone of its operational purpose. Another incorrect approach is to confuse NSCC role with that of the Depository Trust Company, DTC. While DTC immobilizes and holds security certificates, facilitating their transfer electronically, it does not act as a CCP. Misattributing the CCP function to DTC would demonstrate a fundamental misunderstanding of the distinct roles these entities play in the post-trade process. Finally, an approach that suggests NSCC's primary role is to facilitate direct bilateral settlement between parties ignores its core function as a CCP, which interposes itself to guarantee trades. This would be a significant misinterpretation of how NSCC ensures settlement finality and manages risk. Professionals should approach such situations by first identifying the specific entity in question, e.g., NSCC, and then recalling its defined role within the U.S. securities market infrastructure. This involves understanding the regulatory mandates and operational functions of key clearing agencies as outlined by FINRA and the SEC. A systematic review of the firm's operational procedures in relation to these entities, coupled with ongoing training and knowledge reinforcement, is crucial for maintaining compliance and operational excellence. Question 16. The risk matrix shows that unauthorized trading is rated as high likelihood and high impact, while misrepresentation in advertising is rated as moderate likelihood and moderate impact. The firm has limited resources for compliance training and oversight. Which of the following approaches best aligns with developing and implementing a compliance program to prevent violations of securities laws and regulations? Option A. Conduct a comprehensive review of all past advertising materials for potential misrepresentations, regardless of the risk matrix. Option B. Distribute compliance training resources equally across all identified risk areas, including unauthorized trading and misrepresentation in advertising. Option C. Focus compliance efforts on areas with the highest number of past violations, even if the risk matrix indicates lower overall risk for those areas. Option D. Allocate the majority of compliance resources to developing enhanced controls and training, specifically targeting unauthorized trading, while maintaining existing controls for misrepresentation in advertising. The correct answer is D. Allocate the majority of compliance resources to developing enhanced controls and training, specifically targeting unauthorized trading, while maintaining existing controls for misrepresentation in advertising. Explanation: this scenario is professionally challenging because a principal must interpret a risk matrix, which is a tool for prioritizing compliance efforts, and then determine the most effective strategy for allocating limited resources to address identified risks. The principal's judgment is critical in ensuring the firm's compliance program is robust and effectively mitigates potential violations of securities laws and regulations, as mandated by FINRA rules. The correct approach involves prioritizing the highest risk areas identified in the matrix for immediate and comprehensive action. This aligns with the principle of developing and implementing a compliance program that is tailored to the firm's specific business activities and associated risks. FINRA Rule 3010, for example, requires firms to establish and maintain a supervisory system reasonably designed to achieve compliance with applicable securities laws and regulations. A risk-based approach, focusing on the most significant threats, is the most efficient and effective way to meet this requirement. An incorrect approach would be to focus solely on the frequency of past violations, without considering their severity or potential future impact, as indicated by the risk matrix. This fails to adequately address the firm's current and evolving risk profile. Another incorrect approach is to allocate resources evenly across all identified risks, regardless of their assessed level of severity. This dilutes the effectiveness of the compliance program by not concentrating efforts where they are most needed. Finally, ignoring the risk matrix entirely and relying on anecdotal evidence or personal opinion would be a significant failure, as it bypasses a structured, data-driven assessment of compliance vulnerabilities. Professionals should approach such situations by first understanding the methodology and data behind the risk assessment. They must then critically evaluate the identified risks in the context of the firm's business model and regulatory obligations. The decision-making process should prioritize actions that offer the greatest reduction in the firm's overall compliance risk, ensuring that resources are deployed strategically to prevent violations of securities laws and regulations. Question 17. Examination of the data shows that your firm has recently updated its code of ethics to reflect new industry standards and regulatory guidance. As the financial and operations principal, you are responsible for ensuring its effective implementation across all departments. Which of the following represents the most appropriate strategy for achieving this objective? Option A. Conduct mandatory. Interactive training sessions for all employees that explain the code of ethics, provide real-world examples of ethical dilemmas, and include a cue and a session, followed by a signed acknowledgement of understanding. Option B. Post the updated code of ethics on the company intranet and assume employees will access and review it at their convenience. Option C. Include a brief mention of the updated code of ethics in the next company-wide newsletter and direct employees to the firm's general compliance manual for further details. Option D. Distribute the updated code of ethics via email to all employees and require them to sign an acknowledgement form confirming they have read it. Correct answer is D. Distribute the updated code of ethics via email to all employees and require them to sign an acknowledgement form confirming they have read it. Explanation: this scenario is professionally challenging because it requires a principal to balance the firm's operational efficiency and potential cost savings with the fundamental ethical obligation to ensure all employees understand and adhere to the firm's code of ethics. The principal must consider the practicalities of implementation while upholding regulatory standards and fostering an ethical culture. The correct approach involves a proactive, comprehensive, and documented implementation strategy. This includes clearly communicating the code of ethics to all employees, providing thorough training that explains its principles and practical application, and establishing a mechanism for employees to acknowledge their understanding and commitment. This approach directly addresses the FINRA Rule 3110 requirements for supervision and compliance, as well as the broader ethical imperative for firms to establish and enforce ethical standards. By ensuring employees are not only aware, but also understand the implications of the code, the firm minimizes the risk of violations and demonstrates a commitment to ethical conduct, which is a core responsibility of a principal. An incorrect approach would be to assume that simply distributing the code of ethics is sufficient. This fails to meet the regulatory expectation of active supervision and employee training. Employees may not understand the nuances of the code or how it applies to their daily activities, leading to unintentional violations. Another incorrect approach is to rely solely on a general employee handbook without a specific, firm-tailored code of ethics. While a handbook may cover some ethical considerations, a dedicated code provides a more focused and comprehensive framework for conduct within the financial services industry, aligning with specific regulatory expectations. Finally, implementing the code without any follow-up or acknowledgement process leaves the firm without proof of employee awareness and commitment, making it difficult to enforce the code and potentially exposing the firm to regulatory scrutiny. Professionals should approach this by first understanding the regulatory requirements for establishing and enforcing a code of ethics. This involves identifying the specific rules and guidelines applicable to their firm, e.g., FINRA rules. Second, they should assess the firm's current practices and identify any gaps. Third, they should develop a practical and effective implementation plan that includes clear communication, robust training, and a system for acknowledgement and ongoing reinforcement. Finally, they must ensure that the implementation is documented and that there are mechanisms for monitoring compliance and addressing any ethical concerns that arise. Question 18. Assessment of a principal's responsibility when a registered representative expresses significant personal challenges that are impacting their ability to complete their annual continuing education requirements, and the principal is also facing a demanding workload. What is the most appropriate course of action for the principal to ensure compliance with FINRA regulations? Option A. Schedule a dedicated meeting with the registered representative to discuss the continuing education requirements. Explain the regulatory implications of non-compliance for both the individual and the firm, and explore available resources or flexible options for completing the training. Option B. Overlook the immediate need for the continuing education, assuming the registered representative will eventually complete it before any significant regulatory deadline passes. Option C. Advise the registered representative to prioritize their personal issues and suggest they complete the continuing education when their personal situation improves, without setting a specific follow-up date. Option D. Inform the registered representative that, while their personal challenges are understood, the principal's own heavy workload prevents them from offering direct assistance, and the representative must find a way to complete the CE independently. The correct answer is A. Schedule a dedicated meeting with the registered representative to discuss the continuing education requirements, explain the regulatory implications of non-compliance for both the individual and the firm, and explore available resources or flexible options for completing the training. Explanation. This scenario presents a professional challenge because it requires a principal to balance the firm's operational needs with the regulatory obligation to ensure all registered personnel maintain their licenses through continuing education. The principal's direct involvement in the registered representative's personal life, coupled with the representative's expressed reluctance, and the principal's own busy schedule, creates a conflict between personal relationships, business demands, and strict regulatory compliance. Careful judgment is required to uphold FINRA rules without alienating a valuable employee or creating an environment where compliance is seen as optional. The correct approach involves the principal directly addressing the continuing education requirement with the registered representative, emphasizing the regulatory mandate and the consequences of non-compliance for both the individual and the firm. This approach prioritizes regulatory adherence by clearly communicating the obligation and offering support to meet it. FINRA Rule 1250, Continuing Education Requirements, mandates that all registered persons complete annual regulatory element and firm element continuing education. Failure to do so can result in the termination of registration. As a principal, the individual has a supervisory responsibility to ensure their firm's registered representatives comply with these requirements. An incorrect approach would be to dismiss the representative's concerns due to the principal's own busy schedule. This fails to acknowledge the seriousness of the regulatory requirement and abdicates supervisory responsibility. It suggests that personal convenience or workload can supersede FINRA rules, which is a direct violation of a principal's duties. Another incorrect approach would be to suggest the registered representative simply figure it out or deal with it later. This demonstrates a lack of proactive supervision and a failure to provide necessary guidance. While the representative is ultimately responsible for their own CE, the principal has a duty to ensure the representative understands the requirements and has the resources to comply. This approach creates an environment where compliance is not actively managed. A further incorrect approach would be to ignore the situation, hoping the representative will eventually complete the CE. This passive stance is a significant supervisory failure. FINRA expects principals to actively monitor and ensure compliance with all applicable rules, including continuing education. Ignoring the issue allows a potential compliance breach to fester, putting both the representative and the firm at risk. The professional decision-making process for similar situations should involve 1. Identifying the core regulatory requirement. 2. Assessing the immediate compliance risk. 3. Communicating the requirement clearly and directly to the responsible party. 4. Offering appropriate support and resources to facilitate compliance. 5. Documenting the communication and any actions taken. 6. Following up to ensure completion and address any ongoing issues. This systematic approach ensures that regulatory obligations are met while fostering a culture of compliance within the firm. Question 19. Which approach would be most appropriate for a financial and operations principal FINAP to ensure compliance when reviewing advertising and sales literature for a new investment product, considering the need for timely market entry? Option A. Implementing a thorough review process by the FINAP or a designated qualified individual, verifying factual accuracy, completeness, and adherence to FINRA Rule 2210, including all required disclosures and disclaimers before dissemination. Option B. Conducting a quick scan of the literature to ensure it looks professional and aligns with the firm's general branding. Option C. Relying on the marketing department's assurance that the materials are accurate and compliant, as they are responsible for content creation. Option D. Approving the literature based on its potential to generate significant sales, assuming that if it's persuasive, it's likely compliant. Correct answer is C. Relying on the marketing department's assurance that the materials are accurate and compliant, as they are responsible for content creation. Explanation. This scenario is professionally challenging because the FINAP, Financial and Operations Principal, is responsible for ensuring that all communications, including advertising and sales literature, comply with FINRA rules. The pressure to release marketing materials quickly to capitalize on market opportunities can create a conflict with the need for thorough review. A robust review process is critical to prevent misleading statements, omissions of material facts, and other violations that could harm investors and result in regulatory sanctions. The correct approach involves a comprehensive review by the FINAP or a designated qualified individual under their supervision to verify accuracy, completeness, and compliance with all applicable FINRA rules, particularly Rule 2210, communications with the public. This includes ensuring that the literature is fair, balanced, and not misleading, and that any performance data is presented in a manner that is not exaggerated or deceptive. The FINAP ultimate responsibility is to protect the investing public and maintain the firm's integrity. An incorrect approach that relies solely on the marketing department's assurance is professionally unacceptable because it abdicates the FINAP regulatory responsibility. The marketing department's primary objective is promotion, which may not align with regulatory compliance. Another incorrect approach, which involves a cursory review without specific attention to FINRA Rule 2210 requirements for content, disclosures, and approvals, fails to meet the standard of care expected of a principal. Finally, an approach that approves literature based on its perceived effectiveness without verifying its factual accuracy and regulatory compliance is a direct violation of the FINAP duties and exposes the firm to significant risk. Professionals should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves understanding the specific requirements of FINRA Rule 2210, establishing clear internal procedures for review and approval, ensuring adequate training for all personnel involved in communications, and maintaining meticulous records of the review process. When in doubt, seeking clarification from legal or compliance departments, or even delaying a release until full compliance is achieved, is the prudent course of action. Question 20. Implementation of a new client onboarding system that promises to reduce processing time by 20% is being considered. As the FinUp, which approach best ensures compliance with the Series 101 exams regulatory framework? Option A. Conduct a thorough review of the proposed system's data handling and record retention capabilities against SEC Rule 17A4 and FINRA Rule 4511, ensuring all required customer information is captured and accessible for the mandated retention period. Option B. Implement the system with a focus on the speed of onboarding, assuming that any minor discrepancies in record keeping will be addressed in a future update. Option C. Approve the system immediately based on the vendor's assurance that it meets all industry standards and will reduce operational costs. Option D. Prioritize the cost savings associated with the new system, deferring a detailed regulatory review until after the system has been fully integrated into operations. The correct answer is A. Conduct a thorough review of the proposed system's data handling and record retention capabilities against SEC Rule 17A4 and FINRA Rule 4511, ensuring all required customer information is captured and accessible for the mandated retention period. Explanation. This scenario presents a professional challenge because a financial and operations principal FinUp must balance the firm's operational efficiency with strict adherence to regulatory requirements concerning customer account protection and record keeping. The FinUp responsibility is to ensure that the firm's systems and procedures comply with all applicable rules, even when faced with pressure to streamline processes. Careful judgment is required to identify potential compliance gaps that could arise from seemingly minor operational adjustments. The correct approach involves a thorough review of the proposed system change against all relevant FINRA rules, particularly those pertaining to customer account information, record retention, and the safeguarding of customer assets. This approach prioritizes regulatory compliance and customer protection above all else. Specifically, the FinUp must verify that the new system maintains the integrity and accessibility of customer records as required by SEC Rule 17A4 and FINRA Rule 4511. The ethical justification lies in the FinUp fiduciary duty to the firm's customers and the firm's obligation to operate in a manner that upholds market integrity. An incorrect approach that focuses solely on cost savings without a comprehensive regulatory impact assessment fails to meet the FinUp core responsibilities. This approach risks violating record-keeping requirements, potentially leading to significant fines, disciplinary actions, and reputational damage. Another incorrect approach that assumes existing vendor compliance is sufficient without independent verification overlooks the firm's ultimate responsibility for its own compliance. This can lead to overlooking specific nuances of the firm's operations that may not be covered by a generic vendor solution. An approach that prioritizes speed of implementation over thoroughness risks introducing errors or omissions that could have serious regulatory consequences, such as inaccurate reporting or inadequate data security. Professionals should employ a risk-based approach to system changes. This involves identifying potential regulatory risks associated with any proposed change, assessing the likelihood and impact of those risks, and implementing controls to mitigate them. Before approving any operational change, a FinUp should conduct a detailed review of the relevant regulatory framework, consult with legal and compliance departments, and ensure that adequate testing is performed to confirm compliance.